Hi Nick.
Heather.
As a global fund manager, you can invest in any one of thousands of companies. How do you know where to start?
Well, we've got a really clear set of criteria that we're looking for potential investments. Essentially, we're looking to identify companies with brands or franchises that have been around for a long, long time. Decades, or actually preferably brands that have been around for centuries. At the same time, we want to believe that those brands or franchises are going to remain relevant for decades and maybe even centuries into the future. And truth is, there just aren't that many companies that we can identify anyway, all around the world, that meet those sort of criteria of longevity and sustainability into the future. Just to put some numbers on this, in our global research database, I think we've got about 175 companies only, as you remarked.
And that's across the whole world?
Across the whole world. As you remarked, there are thousands upon thousands of companies, some of which are probably going to be absolutely fine as investments, but they maybe just don't fit the criteria, the really quite stringent criteria that we set. When you get right down to it though, that 175 companies that we're following worldwide, we winnow that down even further. We've only got 25 holdings in our global portfolio.
And can you give me an example of a company that you hold at the moment, or one that really just sums up everything that it is that you're looking for in a company?
The last new holding which we initiated the best part of 2 years ago was Rémy Cointreau. Rémy is responsible for Rémy Martin, which is the #1 premium cognac on the planet. Rémy Martin as a brand has been around since 1714. So you can see that meets the requirement we have for longevity. Yeah, that's been around for, over 300 years. Now, the thing was, 2 years ago, there was a relatively short-lived phase in equity markets where people were worried about China's economic growth. Actually, people were right to worry about China's economic growth. It was slowing. Rémy sells a lot of cognac to China. As a result, Rémy's share price essentially halved over an 18-month period. As a business that we followed out of our 175, as a business we followed for 20 years, that was a wonderful opportunity to access to us what is one of the world's truly great, unique brands.
Now, the companies in your portfolio won't always be performing well, not all of them all at the same time. Pearson, for example, is an example of a company that's not performed that well for you recently. And I understand you still hold it in the portfolio. Why is that?
Yeah, it's an absolutely fair question. Let me say, we take the responsibility that we have on the behalf of other people's precious savings very, very seriously. But you're absolutely right. To date, we have retained the holding in Pearson. We've done so because we don't yet regard the investment as having failed. The central reason that we invested in that company 6 or 7 years ago remains valid. And that central reason is that this is a company in transition, moving from being literally an analog publisher of books, textbooks, to a company that's selling software services to educational establishments all around the world. If they can make a success of that transition, the company will become to be perceived as, in our opinion, one of the world's great growth businesses. Now, that looks like an absurdly rosy prospect today. Don't get me wrong, we're dismayed by the experience. But if you look at the trends within Pearson's business, it is moving in that direction, and we're very loath just to cut the investment today at a point at which that outcome is still a possibility.
Yeah.
But we'll get back to you.
So let's just go back to the portfolio and the way that you run money. Your turnover, and by that I mean the amount that you buy and sell shares, is very low, isn't it? It's around 2%. If you're not buying and selling companies, what is it that you spend your day doing? What does your day look like?
The one word answer, and I'm really serious about this, is reading. We as a team read an enormous amount. We have a library at Linsell Train, 4 walls of a room covered in books about investment, about economics, about industries. Yeah, my answer is that we spend much more time reading, taking notes, and maybe thinking than the more action-oriented investor would. That's not to disparage other approaches, but it is in the answer to your question, what on earth do you do?
What is your general outlook for the UK and the UK stock markets?
I'm so enthusiastic about the outlook for the global economy, of which the UK is an important part. And I think the reason why it's so important to be positive is to observe financial history. What makes markets go up is nothing to do with politics or interest rates or inflation. What makes markets go up are successive waves of technological innovation. Yeah? It's technology innovation that creates new wealth for consumers to spend and creates productivity gains that means that companies become more profitable. The fact is, and I think everybody recognizes this in their day-to-day lives, we are in the midst of one of the epochal shifts in the way that the world works. Digital is fundamentally increasing disposable income for individuals and allowing companies to improve their profitability. That is a wonderful backdrop for investing in equity. So, I know that there's a lot of worry warts out there. A lot of people have got short and medium term concerns, but I'd say, don't take your gaze away from that long-term trajectory of wealth creation being driven by technology change. We're in the midst of an extraordinary era, and don't miss out.
That's great. Thank you very much, Nick.